Welcome to ECN Trade Daily Video. Before we begin, it should be noted that any advice is of a general nature only and that your personal circumstances have not been taken into consideration.
Hello everyone, my name is Rob Clayton and thank you for joining me. The Australian dollar gained momentum following hotter than expected May CPI figures, which sparked discussions of potential interest rate hikes amongst traders. Data from the Australian Bureau of Statistics, the ABS, revealed a sharp increase in the monthly consumer price index, or the CPI, to 4% year over year in May, marking a 6-month high and surpassing the forecast of 3.8%. This uptick followed April's figures by 3.6%. Despite the stronger than expected economic data, the RBA is expected to adapt to a wait-and-see approach, so no doubt any views of a rate hike are not quite in the picture yet. Meanwhile, no doubt investors are eagerly awaiting today's update on the US gross domestic product GDP quarter over quarter, with a forecast of 1.4%, slightly up from the previous figures of 1.3%. And along with this, on Friday, May's personal consumption expenditures, or the PCE index, which is the Fed's preferred inflation measure. Minimal monthly increases in the PCE index could prompt considerations for an interest rate cuts, potentially starting in September, but there are discussions of hinting towards a possible earlier cut, that is in July. Turning to the technicals, the market for the Australian dollar keeping its momentum briefly stabbed at the top side level, which was close to 67 cents. Still locking this broader range seen around 65.80 to the region of 67 cents. In the view that I see, the market is expected to increase to the top side and look anywhere towards 67 figure to 67.5, given that the RSI is still relatively firm. The MACD is mixed, but I expect it to marry up to the RSI and strengthen, with the ADX eventually showing a bullish trend, and therefore potentially moving beyond 67.5 and onto 68 cents. The euro dollar weakened on Wednesday as the US dollar index, which measures the greenback strength against a basket of 6 major currencies, increased in value from 105.5 to 106. With all eyes on the US key data, it is anticipated that the euro should potentially hold around this level of 106.70 and eventually move on towards 107 to 108. There is bullish divergence here with the MACD as well that should eventually strengthen and see the move to the upside. Conversely, if we see a close under the level of 106.70, it would put a slight dent in the bullish call and possibly see a slide down towards the 106.30 and the base holding firmly that is seen back in April around 105.25 to 55. The Japanese yen continues to show weakness as the dollar bulls push into the 160 zone, with no signs of any intervention from the Bank of Japan. Although traders are keeping a close watch for potential interventions by the Japanese Ministry of Finance, however, there is some indication that they may hold off until the US personal consumption expenditure report has been released, as this may contribute to heightened volatility in the market. Turning to the RSI, there is some divergence to the bear case, and therefore I do anticipate eventually to see this market drop and look towards this trend line, which is somewhere around 157.20 to 30. One thing to note is if you are trading this market, do be aware that volatility, when heightened, can show extreme whipsaw prices, as the candle does extend very aggressively back in April. With all eyes on the Bank of England, no doubt sterling will be quite volatile. And along with that, with the support taken out at 126.40, the market is now attempting to recover. And if we see a break of 126.65, and adding this divergence here could reinstate the upside back towards 127 to 128. But failing this and the break of 126.65, then we could see the market slip further towards 125.65. Wrapping up with commodities, gold took another blow to the downside after it takes out the key level, which was seen at 2,305, and confirming this engulfing candle, and therefore has opened the door towards the region of 2,250 to 70. Now it is assessed that from this bottom side of the range could see a correction and see gold push back and maybe even towards this level around 2,450 in the broader sense. But first of all, let's see how this bearish pattern unfolds and see if it does get to the bottom side of its range before correcting. Wrapping up with oil, we're still waiting for this break to confirm this engulfing candle, which is at 79.70. Once breached, should open the way down towards $76 a barrel. Any upside attempts, as you can see from the long-legged doji, did fail and should again, and therefore look anywhere from 81 to 82 as a near-term cap. Well, that's a wrap. Thank you for joining me, and as always, look after the interest rate report. I hope you enjoy the great start ahead.